Hello and welcome. Today, we're going to get to grips with a topic that catches so many people out: capital gains tax on your assets abroad. Now, it can feel like a real minefield, I know, but don't worry because we've got this fantastic guide put together by the experts at My Tax Accountant to give you some real clarity. So let's get straight into it.
Right, picture this. You've just sold your beautiful holiday home, maybe somewhere in Spain or France, and you're watching that profit land in your bank account. It's a great feeling, isn't it? But what if I told you that exact same profit could open you up to a pretty nasty and frankly very unwelcome tax bill right here in the UK? Well, that is the exact problem we're going to tackle today.
So, here's our game plan. We'll start by uncovering that surprise tax bill. Then, we're going to navigate the huge 2025 tax shakeup. It's a big one. We'll look at a potential 4-year tax holiday, then dive into some really smart reinvestment strategies. We'll cover why it's so important to get this right, and then we'll finish up with your expert next steps.
Okay, let's kick off with that surprise tax bill. The very first thing you need to get your head around is that if you're a UK tax resident, HMRC takes a worldwide view of your finances. They're not just interested in what's happening here in the UK, but absolutely everywhere else too.
So what exactly is capital gains tax, or CGT? Well, in simple terms, it's a tax on the profit you make when you sell an asset that's gone up in value. But, and this is the absolute key point that catches people out, for UK residents, this applies to your worldwide assets. So it doesn't matter if that property was in Portugal or Preston, HMRC wants to know about the gain.
Let's make this a bit more real with an example. Meet Anna. She's a freelance designer living in London. A few years ago, she bought a lovely little flat in Lisbon, and she's just sold it, making a tidy £50,000 profit. Now, she paid all the local taxes in Portugal and thought, brilliant, job done. But she's about to find out there might be a UK tax bill waiting for her. Sound familiar? It happens all the time.
Now, you do get a small tax-free allowance. It's called the annual exemption. But for the 2025-26 tax year, it's only £3,000. So with a 50 grand profit like Anna's, that $3,000 allowance is, well, it's tiny. Most property sales are going to blow right past that limit, no problem.
So, what happens to all the profit above that £3,000? You guessed it, it gets taxed. The rate you pay depends on your UK income. It's 18% if you're a basic rate taxpayer, and it jumps to 24% for higher rate taxpayers. So let's go back to Anna. She's a higher rate taxpayer, which means she's looking at paying 24% on £47,000 of her gain. Do the maths? That's a potential UK tax bill of $11,280. Ouch! A huge, completely unplanned cost. Right, on to our next section. And please, stay with me here because this is a really big deal. From April 2025, the entire system for taxing foreign income and gains for a lot of UK residents is being completely changed. The old, complicated rules, they're gone. A new system is here.
This slide shows the change perfectly. Before April 2025, you might have heard of non-dom status and the remittance basis. Basically, that meant you only paid UK tax on foreign gains if you physically brought the money into the UK. Well, from April 2025, that's all been swept away. It's been replaced by a new system based on tax residence, called the Foreign Income and Gains Regime, or FIG for short. For most people, this means you're taxed on your worldwide gains as they happen, regardless of where the money is.
This major change brings us to the new FIG regime. And you know what? For some people who are new to the UK, it could actually feel a bit like a 4-year tax holiday on their foreign income and gains. Let's have a look at how it works.
So, who gets to use this new FIG regime? Well, the rules are pretty strict. You must have been non-UK resident for at least 10 consecutive tax years before you move here and become a UK resident. If you tick that box, you get this 4-year window where you can claim 100% relief on any new foreign income and gains. They won't be taxed in the UK, even if you bring the cash over. But, and it's a big but, after those 4 years are up, you're taxed on your worldwide gains just like everyone else.
Okay, knowing the rules is one thing, but what can you actually do about it? Let's get practical. Let's look at some really clever strategies you can use to delay or maybe even reduce that potential tax bill. And here's a little pro tip for you. Let's bust a common myth: the fear of being taxed twice on the same profit. The good news is, you won't be. The UK system has something called foreign tax credit relief. So, if you've already paid tax on your property gain abroad, like Anna did in Portugal, you can claim that as a credit against your UK bill. In effect, you just end up paying whichever country's tax rate is higher. You never pay tax twice on the same gain.
Now, here's where it gets really interesting. Did you know you can actually delay paying the tax altogether? It's called business asset rollover relief. I want you to think of it like hitting the pause button on your tax bill. You sell a qualifying business asset, say some land or a building, and you reinvest all the proceeds into a new business asset within 3 years. The tax gets deferred until you eventually sell that new asset. It's a seriously powerful tool for growing your business.
Now for another fantastic strategy, and this one isn't just for business assets. It's called the Enterprise Investment Scheme, or EIS. It's a government scheme designed to encourage people to invest in smaller, growing UK companies. And here's the brilliant part for you. If you take a capital gain from any asset, like Anna's profit from her flat in Lisbon, and you reinvest that gain into qualifying EIS shares, you can defer the capital gains tax liability.
And this slide really shows why EIS is so incredibly popular. It is so much more than just deferring your CGT. First, you can actually reclaim tax you might have already paid. Second, you can claim up to 30% income tax relief on the amount you invest. So, a £50,000 investment could mean getting up to £15,000 back on your income tax bill. Third, any profit you make from the EIS shares themselves is completely free of capital gains tax. And to top it all off, after 2 years, they can be up to 100% exempt from inheritance tax. It's a whole suite of amazing tax benefits packed into one.
So we've looked at the rules and how you can manage the tax, but that's not all. Here's where a lot of people go wrong, and believe me, it can be incredibly costly. Let's talk about the consequences of making a mistake, or worse, just ignoring your obligations.
Ignoring your offshore tax duties is honestly one of the most expensive mistakes you can possibly make. HMRC's penalties are severe, and they all depend on your behavior. Was it a genuine careless error, or did you deliberately try to hide something? As you can see from this table, the penalties escalate really quickly, from up to 30% for a careless mistake, all the way to 100% if it's deliberate and you've tried to conceal it.
Just look at that number for a second. 200%. In the most serious cases, particularly if the asset is in what HMRC calls a high-risk territory, the penalty can be up to 200% of the tax you owe. Let me be clear, that's double the tax, paid on top of the original tax bill. It's financial devastation, and it is simply not worth the risk. Okay, having seen the risks, let's move on to our final and, I think, most important step: how to turn all this knowledge into smart, informed action that's right for your specific circumstances. So let's quickly recap the key takeaways. First, UK residents are taxed on worldwide gains. That's non-negotiable. Second, that annual exemption is tiny, just £3,000. Third, the new FIG regime is a massive change for new arrivals to the UK. Fourth, powerful reliefs like rollover and EIS exist, but they are complex. And finally, the penalties for getting it wrong are just not worth thinking about.
And all of this leads to one crucial question for you to think about. With the rulebook being completely rewritten, are you genuinely confident that you're paying the right amount of tax and not a single penny more? Trying to navigate this landscape alone, especially right now, is incredibly tough.
Now, of course, please remember that all the information we've discussed today is for general guidance only. You shouldn't rely on it exclusively to make your financial decisions. The rules are complex, and your personal situation is unique. So before you take any action, you must consult with a professional tax expert. For that tailored one-to-one advice on your specific situation, whether it's about an overseas property sale, the new FIG regime, or any other tax issue, the experts at My Tax Accountant are there to help. You can call them on 0208-570-8531 or drop them an email at info@mytaxaccountant.co.uk. They will give you the clarity and peace of mind you need. Thanks so much for watching, and don't forget to subscribe for more updates just like this.